Well, I believe now is as good a time as any to get started, and just wanted to start by thanking everyone that was able to join. My name is Jeff Degener. I'm with Prosperity Private Wealth, and I guess I would start by introducing the team. Many of you know I'm one of the partners. Um, Special thanks goes to Jen Fisher, who really helps with the putting this together every week or every month. Every week would be a bit much, but um, a lot goes into it, and thank you, Jen. Rory O'Hara, he was speaker last month on stock plans and incentive stock compensation (RSUs). We've got Shane Fox. There's Sean Fasanella and Sydney Thomas, who's our newest member. So today we're going to be talking a bit about tax efficient investing. And tax efficient investing, I'm sure it's something that resonates with many of you, and it kind of ties into some of the other things that we've talked about over the month's educational calls. And we're going to be joined today by Ryan Gallagher, who is a CFA, which is a chartered financial analyst. Ryan is a vice president with Eaton Vance Distributors, who is a part of Morgan Stanley Investments. He is a wealth strategy specialist in their wealth strategies group, responsible for consulting with internal and external partners on security level and portfolio level solutions to challenges faced by wealthy investors. The group works with financial advisors and the firm's representatives to help educate and implement strategies such as options overlay, charitable giving, customized strategies, and tax loss harvesting, which is something we're going to be focusing here today. See, Ryan, are you able to join?
I'm here. Hi, Jeff.
Okay. How you doing,
Hi,
Ryan?
everybody. Doing well. The sun is finally out here in Philadelphia.
Yes, the sun is out, and there's green on the stock market channel, so it's a good day. It's a good day.
Right.
So as Ryan and I were talking earlier, I figured market volatility. It's something that you've probably heard from any one of us, and it's something that we really believe is here to stay. We're in an environment where interest rates are rising for the first time in my lifetime, pretty much. And Ryan, I think you fall under that same window. But earlier this month, the Fed raised interest rates 50 basis points. Historical times, the Fed tends to raise by 25 basis point increments. But the landscape hasn't changed, and our views on the market and our investment thesis remains consistent. So whether you're speaking with Rory, Shane, myself, the stock market as a whole, whether US or global, is an efficient marketplace, and we're believers in passive investment strategies or utilizing a combination of active and passive. But from that perspective, active can take a number of different shapes and sizes, and that's something we're going to talk a little bit here about. But using low cost investment strategies coupled with a strategic rebalancing process is still a proven combination of success, and it becomes more, I would say, it becomes easier when dealing with retirement accounts, because there's not that consideration of capital gains and tax implications when rebalancing. Today's talk is going to focus a bit more about dealing with taxable investment strategies, and how can we navigate the uncertainties or navigate the markets when they are volatile in the most tax efficient manner possible. I think that's a good segue, Ryan, to maybe talk a bit about market volatility as a whole and how it kind of plays a role in your approach.
Great. Thank you, Jeff, and thank you everyone for your time. I guess it's officially afternoon, so this afternoon. Jeff, appreciate the comments. As you could probably tell, I'm not too popular at cocktail parties, as everything I focus on is tax related. so I tend to part the room pretty quickly. And Jeff, you touched on a little bit about volatility, and obviously it's something that we're all living through right now. The question, of course, always becomes what's next. And while we don't pretend to have a crystal ball at our firm, one of the latest research reports that we had covers everything from fixed income to equities, domestic, international. It's a 5-page report that gets sent out every month. And in that 5-page report, again, across every asset class you could think of, volatility was mentioned 16 times. Specifically, the outlook of volatility is continued to be higher than it has been historically. Now, while I agree with the thought process as it relates to volatility, the conclusion of that piece was effectively saying control what you can control, right? Work with Rory, work with Jeff and Shane to say, let's make sure we have the proper asset allocation, diversification, rebalancing portfolios as a way to effectively minimize the impact of volatility. What I'm here to talk about today and what I would propose is that volatility can be harnessed. It is something that we could take advantage of, not in the traditional mindset of, we think Home Depot is going to do better than Lowe's, but more as it relates to, as you can probably guess by the title of this slide here, tax efficiency. When we think about tax efficiency as it relates to equities, which we'll focus on today, a lot of the thought process stems from the fact that if you look back over the last 10 years, the typical manager, for that matter, has, some have done very, very well, some underperform the benchmark, but the hidden cost to that exposure, or that's the typical active management, as Jeff has alluded to earlier, the manager has a drag of about 1.8% per year in tax cost. We see that on our 1099s at the end of every year, or when working with our accountants and summing up what we owe and what we've been able to take credit for from a loss perspective. That's a meaningful number. It doesn't sound like much, 1.8% per year, but compound that over the same time frame, you're looking at a portfolio that can have as much of a 20% difference in total net wealth. So it's something to be cognizant of. The typical approach to that, and I always think when a title like this, tax efficient investing, the number one mindset as it relates to tax drag or reducing taxes is, of course, to just bring that tax to a zero. That's the lower bound. And there's a couple of legal reasons why ETFs and typically mutual funds cannot pass through losses. What we're here today to talk about is by taking that same concept of, Jeff referred to it as passive investing. So an ETF or an index fund that tracks the S&P 500 or whatever the exposure may be, we're simply proposing that if you took that index and actually cracked it open and own the individual stocks as a part of that index itself, we'll just stick with the S&P 500 for today's conversation, there's a lot of benefits that you have there. One is customization. I'll expand on that more in just a few minutes, but really, again, tax efficiency. Jeff, if you could have flipped to a couple of slides. This is the year last year, a fantastic year in the market. So the S&P 500 was up about 28%, a really a remarkably banner year. Unfortunately, we've given a lot of those gains back to start the year. But if you, again, took the S&P 5 and cracked that open, this is what the individual stock performance looks like. We don't have the names listed on this page, but on the far right-hand side, you can imagine there's a lot of the tech names that have done very well or did well in 2021. On the far left-hand side, a lot of the energy names that have really proven themselves to be resilient in the face of economic and political uncertainty. The idea and the concept behind tax management is there will be losses, even in a year like last year when the market's up 28%. As the title, I think it's a very creative title because I came up with it. Losses aren't the goal, but every investor experiences them. When you own a single ETF or an index fund for that matter, what you don't see is all of the gyrations in the individual stock level like you see here. This chart, you can imagine, will look very differently throughout the course of the year. As a matter of fact, again, another statistic on this page, about 90% of the names in the S&P 500, right? So as a total, up almost 30% for the year, we're down by 10% or more at some point in time. That's volatility in its truest definition. A lot of times people will talk about volatility because the market is down a couple of hundred points or up a couple hundred points. You can imagine the return differences at the individual stock level can be substantial.
So let me
Yes, Jeff,
pause you right there. So just to conceptualize what you just said, at some point in the year, so this shows year-end return of, you know, the 500 names within the S&P, but at some point throughout the year, 90% of these names were down by 10%.
Correct.
That's pretty wild. Yeah.
And that's in a year when the market was up 28%. You'll see in just a minute, in a different market environment, more similar to what we're going through now, what that statistic looks like. So the point here, Jeff, to sum it up, is there's a lot of volatility that is actually hidden. It's at the individual stock level, and we're going to talk about how to take advantage of that in just a second.
Yeah, and just to, you know, I guess not beat a dead horse, but tax loss harvesting, it's not a new concept.
Yeah.
You know, it's something that can be done, you know, at the mutual fund level, but involves more, you know, I'd say more onus on the advisor or on the, you know, individual managing the account. And I look at this as, I mean, you probably have heard Rory, myself, Shane mention playing offense, you know, in a good market and in a bad market, and in a bad market, playing offense becomes a little bit more difficult, but this is one of those ways to play offense.
Yeah, Jeff, you hit the nail on the head. Tax loss harvesting. It's not something we've created. It's a strategy as old as taxes themselves, right? Where I might have one security or one fund, for that matter, that has a loss. I can sell that and realize that tax loss, and then go out and buy something very similar, right? So whether that's done at the ETF or fund level, or as what we propose here is the individual security level. You know, think of selling Home Depot and replacing it with Lowe's, or Pepsi and Coca-Cola. While they're not perfectly aligned, they are and do perform very, very closely in conjunction with each other. The concept of tax loss harvesting, though, many folks will wait to the end of the year to do it. Jeff, if you can go to the next slide, I'll actually touch on this. Let's go back a couple of years to 2020. Remember, we all, of course, lived through the tragedy of COVID, but also the market sell-off. If we waited towards the end of the year to step in and to start tax loss harvesting portfolios, there were no losses to take. Even in that crazy year, it's hard to imagine we finished the year positive 18%, but we did. So you can imagine the concept of, yes, we do tax loss harvesting, we wait till once a year. There's not always the opportunity to do that. So tax loss harvesting, when done at the individual security level, is looked at on a daily basis. Today, the market is up substantially. That's great news. There's not a lot of losses to take in a portfolio. The previous couple of days have provided plenty of work to keep us busy, with the objective of, again, just simply realizing tax losses. Volatility is happening and is likely here to stay. Aggressive tax loss harvesting is one method that you can use to play offense, to Jeff's point.
Yeah, and I'm going to ask a rhetorical question, but I feel we are ingrained with this concept of, you know, especially within a taxable account, I buy something, I need to hold it for 1 year. Why does that not matter in this case?
Sure. Well, if you have a gain, Jeff, we will try to hold portfolio securities for a year. But imagine if you funded an account last Thursday, probably a difficult time. If you funded a portfolio with all cash and the market's down a couple hundred points, you know, you're pulling your hair out thinking, geez, I couldn't have picked a worse time. But to Jeff's point, and what he's highlighting is the fact that there's value in short-term losses. So short-term capital gains you can use to offset short-term losses can be used to offset short-term losses and long-term capital gains. So there is a substantial benefit from a tax perspective to realizing short-term losses. And that's something that tax-efficient managers should try to maximize. I know it sounds a little counterintuitive. We're in this for appreciation and for ultimately for capital gains, but harvesting losses, specifically short-term along the way, is a very powerful tax tool.
Thank you.
Yeah.
And so what are we looking at here on this chart relative to the
Sure.
prior?
So 2020, again, a positive year for the market itself, for the S&P 500, up 18.5%. But let's look at the volatility that's similar to a profile that we're experiencing today. If you looked at the snapshot of just the individual stocks at the end of the year, it's about 2/3 that have appreciated and maybe 1/3 that actually finished the year with a loss. But again, the key to this is by looking at securities on an individual basis all throughout the year in a scale that's perhaps more institutional in nature, 417 stocks, or about 80% of the market, was down not by 10%, but by 25% at some point in time. And what that is simply saying is that this chart, again, will look very different throughout the course of the year. That is the opportunity set that Rory and Jeff and Shane and team take advantage from a tax loss harvesting standpoint.
So talk a minute about you mentioned the tax drag represented with mutual
Yep.
funds, and believe me, mutual funds have their place. It's
Absolutely
something that we're not speaking that one's better than another. We just have views on active versus passive, more or less, and where they might fit in. So this, in essence, isn't an end-all be-all strategy. It's also a strategy that's irrelevant within retirement. So it's specific to taxable accounts.
Yep.
And there's always, I would say, legislative risks, changes to tax law, but everyone's kind of, everyone participates within that, and it's, dependent upon what the political environment is at that, at that juncture. But you mentioned the tax drag of mutual funds, but maybe talk a minute about, the tax alpha or the benefits of having sort of a tax overlay approach.
Yeah, and to basically to quantify the value of everything we've touched on and talked about as it relates to tax loss harvesting and that tax mindset. Remember, the traditional manager has a drag of about 1.8%. There are structures out there such as ETFs and index mutual funds where that tax cost goes to zero. What we're able to show and demonstrate since 1998 is we've been adding anywhere from 1% to 2% to the S&P 500 in our case per year since 1998. So again, I think a lot of folks intuitively say, let's get defensive and try to reduce that tax drag by bringing that down to the lower bound of zero. We're simply saying the value of the losses, and we'll go through a numerical breakdown of what that looks like in a second, can add to the performance of the S&P. If it's up 18.5, that's great. We're adding, in a year like that, we added almost double-digit returns on top of the performance of the index. So it's same exposure, same names. It's just cracking that egg open and owning it in a more tax-efficient structure.
So just to take that, I guess, a step further, the landscape of the investment universe,
Sure.
in today's age, and it's evolved. It'll only continue to evolve. But many people are familiar with the mutual fund concept, and it's the mutual fund typically owns an investment that all has a, will track a similar benchmark or have a similar theme, and there's typically a disciplined process on how, and I guess to that point, there is a portfolio management team that's determining what within that subset they're going to own and how they're going to own it.
Mm-hmm.
I think more importantly, they have what's called a buy-sell discipline. Passive, which historically or initially when ETFs came onto the became available to investors, it was your plain vanilla ETFs or passive investments, and that's owning the S&P 500. And we've evolved today to have access to now ETFs that have certain active components, or they call them factor-based ETFs. And when you add any layer of active, you're typically increasing the cost or the expense a bit. This structure, in essence, is considered a separately managed account. A separately managed account is like owning And it can be like owning a mutual fund, but you're owning the internal components of that mutual fund. What they have constructed here is more or less a separately managed account version of an index. So they're owning everything within the index or to a degree, and their goal is to track as close to the index as possible. So, I mean, when I talk about harvesting losses, clients are like, yeah, I kind of want to make money. So the performance is the number one goal, tracking as close to what that index tracks in terms of performance. The losses that are harvested are what is done intra-year and can be used to offset gains. And the way I explain it to clients is it really provides us with greater ability to be a little bit more active within the other parts of your taxable portfolio, rather than becoming married to a portfolio because it's appreciated in value.
Jeff, great points. The way I would describe this way of thinking is this is passive exposure, right? It's the performance of the S&P 500. If it's up, down, flat, left, or right, that's what the portfolio will perform. That's the performance of the portfolio, but it's active tax management, and that is where the additional 1% to 2% comes from, not the traditional. Again, I think that Johnson & Johnson is going to do better than Pfizer over the next 6 months.
Yeah.
And Jeff, if you could just go to the next slide, I wanted to build on one of the points that you mentioned as it relates to mutual funds, and I don't mean to disparage that approach. The reality is that there are managers out there that do phenomenal, and this thesis and this way of thinking, this tax efficient approach, really has to rely on that. And what I mean by that is the typical the managers that do very well, or the rebalancing or the asset allocation decisions that are perhaps the most important consideration, that tax drag is something it works in conjunction with. So it's okay to be off by 1.8% per year on an after-tax basis. If the market's up 5 and you're up 20, that's something that everyone would of course do. But by simply blending the two, by using a strategy such as this, we're able to get that performance of the market, because some years the manager may underperform. Whether that's a mutual fund, a private equity, hedge funds, what have you, whatever the structure is, this is designed to just fit and be a piece of your overall portfolio, with the thought process being that instead of a mutual fund or an ETF or another structure, you own the individual securities. And what that means for tax purposes is you own the tax losses. You can use them how and where you'd like to. Maybe you have a large tax event coming due at the end of the year. A strategy such as this will start to build up this bank of losses, so that when you do go to file your taxes next year, you have some losses to help minimize that tax drag. Or, as we touched on earlier, kind of rebalancing at the portfolio level. I know a lot of folks are thinking of perhaps moving from growth to value. Think about, that move is selling out of growth portfolios to buy value portfolios. That's going to have a taxable consequence. Again, that's where this cash of losses can come in handy. So this slide, kind of fancy with just a bunch of bubbles on it and a few arrows, but really it's simply saying the losses that we harvest for you in these portfolios are portable. You own them, you control them, you can carry them forward as long as you'd like to. So it does create a much more holistically tax efficient portfolio for your overall taxable accounts. And
I think it's also important to touch on, many of you may be familiar with the concept of a wash sale, and I'll let you kind of take that one. Just how, I guess, more or less the concept of a wash sale is if you own Home Depot and December 15th it's at a loss and you want to recognize that loss and you liquidate Home Depot, but January 1 you purchase it back in the new tax year, the government does not let you actually recognize that loss, and the wash sale rules apply, and you get a very complicated. You might be able to explain it more detail, but I do have a story to tell, on the tail end.
Sure. Again, another great cocktail conversation is wash sale rules and tax implications there. really the idea is the IRS says, wait a second, Jeff, to your point, you can't sell, I think you used Home Depot for $1 loss and then buy it back the very next minute later and, be back into the position. You haven't really realized that loss. So the rule is you can't come back to Home Depot for typically 30 days. So you can realize the loss as long as you stay out of the name for 30 days. You can buy it back on the 31st day. It's a very important consideration for tax managed strategies because you can imagine if we're doing all of this work and all of this activity, but we're robbing Peter to pay Paul, the net effect for tax purposes is zero. So it's a very important consideration at the portfolio level.
So how, in essence, are you able to maintain, low tracking error, which means that you're trying to generate like returns of the index when you liquidate securities?
Yeah. So the reason the performance of our portfolios tracks so closely to the S&P 500 is because we build a portfolio that has all of the DNA, if you will, of the S&P 500. What it doesn't have is there's ironically 505 names in the S&P 500. It doesn't have the 505th name. As a matter of fact, we typically own about 350 positions in our portfolios. And, from a math standpoint, the way that these indexes are built, Apple is the largest company out there. It has the largest weighting in the index. I don't know what the 505th company is. Probably a good trivia question, but that weighting is probably 0.0001%. And what that means is if that stock doubled or went bankrupt, the index would not move a single cent. So we're able to basically take advantage of that by saying we don't need to own every single name in the index. But what that does is that does give us the flexibility to say we want to move from some of our Home Depot into another position. Or, I keep using those two pairings, but we want to sell some of our J&J, and we've got a host of names on the sideline, Jeff, that we can reinvest those proceeds into that very same day. It brings up an interesting point, though, and I think this is a key consideration. Tax loss harvesting is great, but again, the goal is to make money. We want capital appreciation. And the reason I'm emphasizing that is it's very easy, especially in these times, to be very aggressive with loss harvesting. The problem is you want to make sure you've got a portfolio that's going to do and perform like you set out to do. So you don't want to be realizing all of these tax losses sitting in cash for 31 days due to that wash sale rule that we covered, and then the market takes off while you're in cash. So it's very important to find that balance, if you will, between keeping the exposure in check and making sure you have the performance of your of the goal that you've perhaps given us, while taking losses as aggressively as possible.
Perfect. And the story I would share is, and it kind of resonates with the talk last week about restricted shares, stock options, and the sort. But there are clients, of mine that come from a company that has restricted stock units that vest on a monthly basis. Because of this, they cannot liquidate those shares and realize a loss, because when the new shares vest, it's as if they repurchased them. So the wash sale rules apply. And to combat that, in essence, we diversified some of those positions, implemented parametric, which in essence is going to help them, offset gains when they do sell shares of the company stock. But, with respect to time, I did want to, I don't know if there's anything on here that you want to touch on. I think one thing that jumps out to me is the customization, and the ability to tailor, the portfolio to a degree. So why don't you maybe talk a minute about that, and then we can come full circle with the example.
Sure. So customization, given the nature and the structure of these separately managed accounts, right? You own the positions. You can control really as little or as much as you'd like. A lot of folks come to us and just say, I want to buy the S&P 500. But then there's a lot of folks, Jeff, such as your example, where they have enough exposure to one particular name, whether it's from working at a firm or inheriting a position, just waking up in the morning. So why buy the S&P 500 if you already work at Apple, let's just say? So we customize portfolios in that sense. We often implement different environmental, social, and governance factors into these as well. So everything from I don't want to own tobacco providers to we do have an account that they want to own more alcohol providers. You can really shape it however you want. Faith-based investing as well, Catholic values. We have about $1 billion in Catholic values investing alone, but we also do J-Lens portfolios, Sharia compliant, Baptist values, etc. So a whole host of different ways to basically shape the exposure. The most common customization, however, with all of that said, is actually the manner with which we fund portfolios. You don't need to use cash to build a parametric portfolio, which is what we're talking about here. 60% of all of our accounts, that's about 50,000 portfolios at 190 billion in assets. 60% of those have actually come from existing positions, meaning, let's just say I have 30 stocks with embedded capital gains. How do I get those more diversified and maybe get those to the index I was trying to beat in the first place? Parametric can help you with that conversation. Again, similar to the concept of owning some of the DNA in the index, that's great. You already own a lot of that DNA, and we can work with you to help minimize the taxes upon inception. Tax efficiency on a going forward basis is great, but what's crucial is if it costs you an arm and a leg from a tax perspective up front to start that program, then all of a sudden it starts to lose its luster. So customization can really work, Jeff, in a myriad of ways.
Yeah. And I've experienced that firsthand, with some of my clients in terms of making the transition over the course of, 1 or 2 tax years. And what they provided is the impact or the tax impact of doing that. We've also worked through situations where we've established a capital gains budget to say, this is the number that we're willing to realize. We want to get as close to the index as possible. As they were harvesting losses, we could then make the jump even further so that we, in essence, we're trying to keep certain guardrails on. I think everybody loves a good example to help better conceptualize. So why don't you kind of share a little bit of detail here?
Sure. There's before I do, there's an old SNL skit that says, never put too many numbers on one page. And somewhere in marketing, that was lost. So there's a lot going on here. I'll do my best to kind of just walk you through it. Because the concept of outperformance or tax efficiency, outperforming the index by 1 to 2%, that's great, but what does that really mean from a tax perspective? And so what we've done here is just kind of broken down or demystified outperformance or tax alpha, whatever the financial jargon may be. On the center column, the hypothetical account versus the benchmark, this is $1 million portfolio. The performance of the account, as you can see, very, very closely to the benchmark itself. We don't own every single name, so you have that slight difference. And in this case, we've taken some of the credit off the board by saying we've underperformed. Same dividends, it's the same constituents as the benchmark. The difference is follow the benchmark tax implication for a second, is 0. Remember, most folks think that the lower bound to tax efficiency is just to reduce the capital gain. The hypothetical account here in this portfolio has $40,000 of short-term losses. We talked about the increased benefit there, and the long-term losses of an additional $12,000. That's $52,000 on $1 million portfolio. Not without side. It's a relative conservative number to be totally frank. This year alone, just to give you an example, about 10% in losses harvested, and we're still early in the second quarter. What does that mean from a tax standpoint? Your accountants will love this because now all of a sudden they have a portfolio with $52,000 of losses. And if we apply that to capital gains that you have elsewhere, again, from unwinding a concentrated stock, as Jeff mentioned, or from other managers or areas of your portfolio, that tax savings, if you look, Jeff, a couple line items down, is about $16,000 on short-term losses and $2,800 on long-term losses. That's a total savings of about $19,000. It's the same exposure as what you see on the right-hand side with the benchmark, same dividend yield, etc. That's what we're talking about. Losses aren't the goal, but they are there, and it is a substantial opportunity to take advantage of. These numbers, I mentioned 10% for the year, only increase as volatility does. The more those charts that we showed you earlier, where some of the names finish up and down and what that looks like throughout the year, the more that those bounce around, the higher those numbers become. So again, taking advantage of volatility, this is really a great way to quantify this, to actually see the tax savings that you would have in a portfolio.
Yeah. So to conceptualize that, on $1 million portfolio, they've been able to harvest, on average, $100,000, split between long and short, whether, depending upon what, at what point did you start.
Yep.
Yeah, that's powerful stuff. And again, I think another consideration, just to wrap up here, is managing a portfolio efficiently from a tax perspective becomes more relevant when tax rates are high. All things considering, I know people feel that tax rates are relatively high, but I mean, all things considering, we're in a very low tax rate environment, which was in effect from the Trump era and the 2017 Tax Cuts and Jobs Act, which is due to sunset at the end of 2025. And I'm sure the writing is on the wall for many folks. And if you had to, bet your life savings one way or another, you would say tax rates are very likely to go up in the future relative to down. Now, this isn't us forecasting. It's more or less, a view that we have. And we're also, not holding ourselves out to provide tax advice, but it's one of those things that you almost want to use a hockey analogy. You want to skate to where the puck is heading. And I truly believe, I mean, I've worked with Ryan probably for 6-7 years now. It's a strategy that we've grown to really appreciate, and companies are beginning to more than ever compensate employees in different ways through incentive comp and shares of the actual company if it's a publicly traded company. So utilizing a strategy like this that has an approach to help offset capital gains or tax ramifications, it allows you to just be more dynamic and manage the other parts of your wealth more efficiently. I think that's most important. Too many people will ride a position up and ride it right back down because there's no systematic approach to say that I want to keep my allocation to, let's just say, Apple stock at 10%. And as between 2011 and 2014, and this is, I always go back to this analogy. I don't know why, but it was prior to any reverse splits. Apple stock was at $400 a share, and it went up to $750 a share, back down to $400. And if you weren't trimming it as it outperformed everything else, you weren't trimming it and then adding to it maybe on the way back down, you went through a 3-year period of muted performance. So this is just something that allows us to play offense in more of a greater manner. Ryan, thank you, sir.
Thank you, everyone, for your time. Again, a lot going on here: tax management, tax efficiency. Any questions you have for me, I'm more than happy to help. If not, I really appreciate your time and hope you have a great rest of your week.
Yeah, I would welcome anyone on here if there's any questions that you want to dig into in more detail. Don't hesitate to send myself or Rory, Shane, Jen an email. We'll make sure that we get in contact with you and make sure those questions get answered and leverage. I'm not shy about leveraging Ryan and his team, so we stay in touch pretty regularly. But thank you, everyone, for joining, and stay tuned for next month. All right, Ryan.
Have a great day.
Take care.